Okay. Thank you all so much for joining us today. My name is Stephanie Foner, and I work in the Office of Alumni Relations at Northeastern on our affinity and domestic engagement team. So first, just a couple housekeeping items. If everyone could make sure that their microphone is on mute, just to make sure we have a good sound quality, that would be very helpful. And if you have any questions or are having any issues, please utilize the chat box. I'll be keeping an eye on it through the course of the event. I also recommend that you put your view onto speaker view. While right now I have a slide up, neither of our presenters are speaking with slides today. So having the view onto speaker view will just ensure that they are the primary person on your screen rather than having the multiple Zoom boxes that we've all, I think, become very familiar with over the last months. And then lastly, our speakers will be presenting for about 30 minutes, and then there will be time for Q&A at the end. Again, please use the chat box during that time, and I will be reading the questions out loud. If you are inspired by something that one of our speakers said during their presentation and you don't want to forget your question, please feel free to put it in the chat box at that moment, and I'll be happy to read it out at the end of the session. Or if it's a clarifying question, I can also jump in just to get a point of clarity as well. So now I am excited to introduce our two speakers today, Jeffery Bourne and Teresa Rodriguez. Jeffery Bourne joined Northeastern in 1988 and has been the DeMoore McKim Associate Dean for Undergraduate Programs since March of 2018. Professor Bourne has been widely published and is frequently quoted in the financial press. He has also been an expert witness in public utility rate hearings and has been an advisor to the governments of Fiji and Tuvalu. Teresa Rodriguez graduated from Northeastern University in 2001 with a finance and marketing degree. She has been serving the financial needs of professionals, business owners, and their families for more than 12 years and is currently a financial advisor at Raymond James. Teresa is also a volunteer alumni leader in our Atlanta community. So now I'm going to stop sharing my screen and I will hand the floor over to Professor Bourne.
Hi. Good afternoon, and thank you all, at least afternoon here in Boston. Thank you all for joining us today. In 2006, my colleague and I, Jack Lee, and I published a little paper entitled Presidential Election Uncertainty and Common Stock Returns in the United States. That paper is now the 15th most cited paper out of the Journal of Financial Research. And every 4 years, when we get ready to return to the long established tradition of voting for president, the people rediscover this paper and Jack and I become famous again. So what did we do that so changed the way people look at elections and their relationship to the stock market? Well, what we did would seem pretty simple on the outside, but it had never been done before. We treated the actual election as uncertain, or the outcome as unknown, when we were looking at common stock returns in the period of time just before the election taking place. And surprisingly, all the other folks that had looked at the relationship between the stock market and winners presumed they knew who the winner was. And sometimes that's pretty easy to figure out. When Ronald Reagan ran for re-election against Walter Mondale, or when Bill Clinton was running for re-election against Bob Dole, those outcomes were pretty much known well in advance. But other elections are and have been quite certain, I mean, quite uncertain, and some unknown even well after the election day, as was the case with Bush versus Gore. So what we did was we took advantage of polling data. And remember, back in 2006, there wasn't as much polling data as there is now. And we focused on Gallup polls. For those of you that are old enough to remember, Gallup used to be the preeminent, almost the only polling group for presidential elections. They're not even in the polling business anymore. But basically what we did was we took advantage, we took the whatever the Democratic candidate had received as a polling number, we subtracted what the Republican candidate had received as a polling number, and we divided that by the margin of error or the sampling error in the poll. And those vary from polling agency to polling agency. But in general, that margin of error, it gets larger as the number of individuals that are actually polled gets smaller. So the bigger the poll, the smaller the margin of error. So we took the difference in the two candidates, their polling numbers, and we divided by this error rate, and we got an uncertainty measure, which we called U. We're not marketing people. We aren't terribly original. And we said that, you know, if that number was larger than 2, either a +2 or a -2, that in a statistical way, the election was pretty certain, and the potential winner was pretty well known. But if the difference, the U was less than 2, then we referred to the election as a toss-up. And so we looked at 10 different elections from 1964 to 2004. That gives you an idea of how long ago this paper got published. And what we found was pretty straightforward, that when elections are uncertain, the stock market tends to rise, and so does volatility. But when the outcome is pretty much known in advance or at that time of the poll, then the period of time the stock market behaves kind of as normal. Returns are normal and volatility are normal. And that makes a fair amount of intuitive sense, I think. If we're unsure about who's going to win, then some bets will pay off and others won't. And so there's a lot of jockeying for position. Who am I betting on? Am I betting on Gore or am I betting on Bush? And it makes a difference because political parties are different and their policies are different once they're in office. But when you know, or when it's virtually certain who is going to be the winner, then the market figures that out, factors it in, and it's already priced out well before the election takes place. And while we have not updated our study since, but lots of other people have, I think we're continuing to see evidence that this is a decent way to think about to think about how elections and the stock market work together. So before I turn it over to Teresa, let me say I went to a site that I go to often to see what's going on. It's 538.com this morning, and I found that the 538 has kind of an average of many polls. So you can't really construct the same index that I did. But looking today, Biden has, by their accounts, nationally 51.8%. Trump is polling at 43.1%. So Biden is ahead by 8.7 points. But let me give you two other little polls to give you an idea of how our study would have worked. So Emerson College released a poll yesterday. It had a margin of error of 2.8%. and they found Joe Biden was ahead by 5 points. So if we were doing research like we did 15 years ago, that U measure would have been 1.78. And so we would have said, nope, the election is uncertain. This morning, the USC released a poll, and their margin of error was much smaller, only 2.15%. And they show Biden ahead by 11.4%. So in the USC poll, their uncertainty measure would have been 5.3. So this gives you an idea with all of these polling vendors, if you will, in the marketplace. Some make it seem as if the outcome of the election is known with certainty. Others show the race to be quite a bit tighter. And that's kind of my kickoff now to Teresa, who's works with investors on a day-to-day basis to try and get them thinking about how this election outcome might impact them and their portfolio. So take it away, Teresa.
Thanks, Jeff. Good afternoon, everybody. I'm very happy to be here, very excited. Anything that has to do with Northeastern is always exciting for me to be a part of. It does feel like another lifetime ago that I was on campus, but we'll just leave it at that. It's been a few years. But yeah, I wanted to first talk to you about a little bit how Raymond James does their research and what we base our commentaries on, and it really does come from our managing director called Ed Mills. And Ed joined Raymond James back in 2017. He has a lot of experience in Washington, D.C. and their policies, more than 15 years. And he also was in the professional staff and a member of the House of Financial Services Subcommittee, and was also a finance policy advisor for the U.S. Senate Committee. He has a lot of experience about everything that's happening in Washington and how that could affect the markets. And also, he went to school in Boston. He actually has a bachelor's from BC. So that's always good to hear. But one of the things that he's been talking about lately is the main 8 themes that we really should be looking at during these elections. And I can't believe we're just a week away from it. But the first one is really the curveball scenarios. And as we all know, we're not going to know next Tuesday night really who the winner is. And the recounts and all the legal challenges that are going to come from that, it's certainly going to throw another wrench into what 2020 has been so far. The second theme is the fiscal support. All eyes are on this economic relief plan. And, he seems to think that in a Democratic sweep, there's going to be a lot more support, more fiscal support, and that might be able to balance out the market reaction to all of these tax and regulatory changes. The third one is tax reform. So if we're looking at a Democratic sweep, it's going to likely mean there's going to be increased taxes for corporations and for high-income households. And this is probably going to impact stock prices on the higher tax industries. So that's the outlook on that. Fourth, post-crisis policy. There's healthcare, labor policy, and depending on what's going to get accomplished, depending on the party that's going to come to the White House, it's really going to show us, how the White House and the Congress is going to be controlled. The fifth, deficit concerns. Obviously, with COVID-19, the relief packages, people are paying a lot more attention about how the government is spending the money, and really should we be more prepared for the future when something like this happens again. Let's learn a lot more about how the government is spending our tax dollars. That's very important. Six is Senate control. Obviously, depending on where this is going to fall, it's going to have a lot of effect in all these policies. let alone in 2022. There are going to be other elections, and that's going to be closely looked by all the investors. Let's not forget China, the trade and all the investment barriers that are going to come regardless of who wins. And we're going to, investors are going to keep paying attention to technology and the human rights issues as well that comes from dealing with China. And lastly, the Fed, which don't fight the Fed. The Fed has been helping unprecedented support for the economy, and it's going to continue regardless of who is going to end up as president after next week. Again, historically, Jeffery was mentioning, the markets have been really cautious and very volatile right before the elections. And one thing to remember is, well, everything that's happening in DC, certainly it's going to impact the economy. What's really important is that you're a long-term investor, that you're investing in quality businesses that can ride the waves as the one that we're looking at right now. As far as what's happening in the market right now, investors are really trading on the fiscal relief headlines, really. And as far as where we stand on that, as we all know right now, very unlikely that we're going to get anything resolved before next Tuesday, particularly because President Trump already said that, the talks are done with. There's nothing going on right now. And that leads us to believe that we likely won't have a package agreed upon, maybe not before 2021, or at least the very beginning of January. And mostly because, politics has gotten in the way. Certainly Raymond James analysts think that, if there's a Democratic sweep, we are going to see it a stronger support on the aid to state and local governments and another round of stimulus checks. If President Trump gets reelected, they're going to have the fastest package come out, not necessarily the strongest one. So, a lot of that has to do with, again, who's going to end up at the White House. Again, this is going to be a contested election. And like Jeffery mentioned, last time this happened was with Gore and Bush. And between the time that they were counting the votes in Florida and the time that the Electoral College stepped in to decide that victory went to President Bush, the market was down almost 7.3% during that time. So just a reminder that we're going to see volatility. You guys know it. It's been happening for the last couple of days. The market, certainly there's a lot of red on there now today. That comes from the investors not having security of the package plan coming out very soon, and also not really knowing what's going to happen on Tuesday, considering everything that happened in 2016. So what's important right now for investors, and what should you really be focusing on? Personally, I think having a good financial plan. If you have a sound plan, if you have a good investment policy statement, you know where you are, where are you going, you can ride out this volatility and really just sit down and stay put and watch it take its course. So that's very important. Always staying on top of your financial plan, having clarity, knowing where you're investing and why you're investing on that. Certainly can give you more of, comfort to deal with the volatility that's happening right now. But just to confirm, it's normal. Don't get scared. This happens every time right before the elections and right after. But once we know who the final chosen candidate is, the market has shown from history, which doesn't mean it's going to happen again, but history has shown us that investors do get more, just more comfortable and start investing again in the market. Jeff, Stephanie, I don't know if you guys want to jump in now. We can certainly open for questions, or we can continue to talk a little bit about the markets.
Yeah, Jeff, do you have anything that Teresa said that you would like to respond to? Otherwise, I'm happy to open the floor to questions. But if Teresa said anything that kind of pinged around in your brain that you have a reaction to, please feel free to hop on and share your reaction.
Oops, I think we lost them.
Oh.
I think, yeah.
I'll be back momentarily. Teresa, if you want to continue. Oh, here he is.
Yeah, I just wanted to make one last comment that as far as the financial sector, which really, it's worrisome. We want to make sure that our banks are stable, that companies are going to be there past, after all of this, the pandemic and the elections. But just so you know, there's 3 points that that show us that there's really a belief that we're going to come back from this. And the first one is that as the economy is going to reopen, employment is going to improve again, the banks are going to start lending money out. So they're going to start experiencing that loan growth and the subsequent reacceleration of earnings. The second one is, we're looking at the S&P financials 1-year forward price over earnings multiples, and they're at the lowest levels in comparison to the last 15 years. And also the reserve levels for a lot of our large banks are at their peak, which means that they are comfortable with the anticipated loan losses that are going to come in the next several quarters. So in other words, there's cushion there to be able to bounce back as the economy continues to come back and reopen. You're back, Jeffrey.
I'd often tease on rainy days, if this was the Second World War, I tell you, I've had bad atmospherics. I have real bandwidth challenges on mornings when there's rain. I apologize. So that was great, Teresa. And I was going to make a couple of observations if I could for a second. I've also done another study that looked at the behavior of President-elect Trump between the time of the election and the inaugural. Most folks who get elected president kind of go into a figurative bunker as they try to prepare for transition, and they're trying to fill out all these positions before they get to Washington. But what was so fascinating about Donald Trump was that he kept on tweeting, right? And in that period of time, he started tweeting about individual companies, like that, saying good things or bad things about them, like, oh, Ford is doing this and they're good, and Boeing is doing this and they're bad. And so we looked at how and said, well, of course, this won't continue because nobody will let the president continue to tweet like this after their president. So I share that with you just to show you why it's better for me to stick to financial analysis rather than political analysis. Obviously, Donald Trump has been a big tweeter, but that period between the actual election and the inauguration, with of the one that you were talking about, Teresa, the long-standing who is it, Bush or Gore question. Most of the time, that post-election period is pretty calm because people really don't know what the new president is going to do once they're in power, and we try and read the tea leaves, right? Who are they appointing? What are they saying? And it's really almost kind of like a timeout for a while. But I think I agree with Teresa. I think this year there are going to be lots of outstanding issues, and I'm not expecting to have a good idea of who the ultimate winner is. I teased my wife and said, maybe we should tune in December and see if we know who the winner will be. That was teasing. But seriously, I think there are going to be a number of questions that, and just the volume of counting that has to take place after, beginning on election day in some really key states is going to really make this kind of an election like no other, which is perfect for 2020, right? A year like no other. It's really been quite different.
And I think
one last, go ahead, please.
I was just going to mention the second surge or third surge in Europe now, and then possibly Germany and France saying that they might close everything again. That's part of, the worry on this side of the world that maybe we'll go into another shutdown, and I'm sure investors are being affected by that too and doing a little bit of selling.
Right. Investors and everybody, parents and teachers and folks worried about what's going on at their place of business. We here at the university are watching very, very carefully what's going on both in Massachusetts and outside of it. And, we have I'd say I have our fingers crossed. We're engaged in a very, very, very aggressive, excuse me, testing policy. But we are a little uncomfortable about where we see new cases rising to, and I think the marketplace is sharing that uncomfortableness with us. The last few days have been a little rocky, and I was saying before we started taping that my retirement is probably inching away from me as this softness in share prices continues. But Stephanie, is this a good time for me to ask if there are folks who have specific questions that they might want to hear us try to address?
Yes, so we actually already have 2 questions in the chat. Everyone consider the floor open. Again, if you have questions, please put them in the chat box and I'll read them out. Both Teresa and Jeffrey have a rule that they don't give personal financial advice to family members. And the same holds true to our Northeastern family here. So broader questions about investments, totally fine. Specific questions about your own personal finances, we're gonna have to either find a way to broaden them or not address those. But the first question is for Teresa, and it is about investments on a broader level. Teresa, if you had funds to invest in a combination of equities and fixed income products, would you go ahead now pre-election, or would you wait until after the election?
Great question. My first train of thought would be during the elections, right before the elections, when there's volatility, because sometimes we just think about investments very simply as buy low, sell high. Again, generalizing, everyone's situation is completely different depending on where you are in your life financially and having your emergency funds and all that good stuff. But I would say that there's always opportunity in anything in life, just like in the stock market. So when things are at a lower price, there's always the opportunity for you to jump in and get something at a cheaper price, hoping that you have a long-term objective.
And that actually feeds pretty well into our next question, which is for the past several days, the markets have been down, partly due to, Teresa, as you mentioned, the no stimulus package. How do you think the stock market could also be in a correction period? Are stocks overpriced? Are they appropriately priced? Are they underpriced? Teresa, why don't you start, and then we will go to Jeff.
Sure. Yeah, it could also be part of a correction, of course, which also happened at the end of 2018. And as many of you guys know, we had a pretty good run. It was close to 11 years of having a bull market, of having amazing returns and a good stable economy. And corrections are normal. They tend to happen. We never know when that's going to happen, but if you look at it generally, and you've been investing for 7 years, for example, and your return has been 13, 14%, you can afford having some corrections, because at the end of the day, you are still getting a pretty good return. So yeah, corrections sometimes are good. And again, during corrections, a lot of people take the advantage to go and buy low and eventually, hopefully, sell high.
Yeah, I would agree with that. I guess what I would say is I think the market is actually looks pretty far ahead when trying to price out securities. And yes, I do agree. The news in the last week about the stimulus package wasn't good, and it did ding the market a bit. But I think for quite a while, what I would categorize is that the belief in the marketplace is that by and large, the US economy has been, has not suffered a serious and sustained problem here. Meaning, what do I mean? Meaning that the telephone poles haven't shrank, the businesses haven't disappeared from the face of the earth, that we are certainly not operating at full capacity, but there is, I think, priced into the marketplace a belief that when the COVID cloud clears, that pretty quickly business life will get back to normal, and maybe even above normal, because of so much delayed consumption that people have put off because they just haven't been able to get out and about in ways that they normally would. So I think the market has a pretty strong and what I would call rosy outlook for the US economy coming up. And I have to say I share that. I'm an optimist, and I think the U.S. economy was strong coming into COVID, and I think that it will return strong. I think what we see from time to time are people getting rightfully concerned, like, when does COVID leave? And boy, if I could tell you that, I'd be a rich person. But I do think that's kind of what is tempering, is like, how long will this last? Encouraged by the developments we're seeing in the vaccine area all the time. I don't know who's going to win that race or how many are going to win that race. But I think the economic incentive to the firms that do is going to be enormous, and people are working very, very, very hard on it, and I have faith in the science on this. So that makes me feel comfortable in saying that this too shall pass, and that things will get back to a new normal, not the same normal, but a new normal. But I think it will be positive. So that's a long-winded way of saying I'm not sure that the market is overpriced. I'm pretty optimistic.
And I'll add, and I agree, and I'll add that, being positive about us coming back and in this passing, it's also an opportunity for the younger folks, everyone that's still in college, to learn from this experience. Just put yourself in the situation of what if you would have already been out in the workplace, and what if you would have lost your job? Did you have enough emergency savings? Did you have another source of income? These are things that we're learning from this pandemic, particularly because we had no warning whatsoever, except for the people that were keeping a good eye on what was happening in China in December, January. But I know most of us weren't doing that. So I would say learn from what's happening this year. Make sure you always have a good foundation for a what if scenario. I know that quite a few years ago, we used to recommend keeping 6 months of emergency funds. Now that's changed. It's from like 8 months to maybe a year of enough funds to cover your rent and your food. Because obviously everything else that we have is luxury at the end of the day. And we won't even get into the conversation of cell phones. But it's just something that we can take that as a learning experience for what's happening.
That's a good point, Teresa. I used to, when I was long ago and far away, when I was a college student, I took particular interest in the business cycle. And so when I was a young man, on average, an up economy would last somewhere in the neighborhood on average of about 4 years. And a recession or kind of a downturn in the economy would last anywhere from about a year to 18 months. And now that I'm no longer a young man and I've seen a lot of history unfold, what I would share with you is that our recoveries are lasting, or our upticks are lasting much, much, much longer. The one from 2010 forward went on almost 10 years. Before that, there was almost 8 years of uninterrupted rises after 2001. Before that, it was another 8-10 year run. So that's the good news. The bad news is that all that prosperity and all that good news makes us think that, well, it's, bad news is never coming. And so we become a little less diligent, right, in the way that we set things aside, because why do you need a rainy day fund? It hasn't rained in 10 years, and in a financial sense. And so I hope we don't become having downturns more often, but certainly it does point out that, there's almost a whole, at least a half a generation never experienced a downturn. They don't know what this is like. And for some people that are in their 40s, they've only been through this once before. So I think we were a little caught by surprise, and certainly the way it arrived, it wasn't a normal recession. This was brought on by by a virus, by a pandemic, and that's a little different. We haven't had one of those actually in a long, long time. So you're right. I think this has been an opportunity for a learning experience for all of us.
So we do have another question.
Sure.
Do you think Wall Street or analysts re-examine positions on corporate capital investments and efficiencies or redundancies, given the supply chain challenges?
I'll step in first, and then you can come on, Teresa. Yes, I do. I think we're all. I think we've seen a variety. the advancements in supply chain in my lifetime have just been enormous, and far-reaching. The firms have now got very distant in terms of their physical space, very, very distant supply chains. So, getting big parts of finished goods from very far away locations is the norm. And also, we've learned how to operate with almost no inventory on hand. So those two things have made us a little more vulnerable to disruptions like we had here this year. But I think the mode that we're in, very little inventory and very tight control on supply chains, is going to be the way of the future for the foreseeable future. And yeah, I think analysts pay a lot of attention to what's going on. Having said that, I think a number of firms are trying to think about locating at least part of their supply chain closer to the United States or back inside the United States. And I think, like a lot of economists, I would welcome that as well. What's Raymond James thinking on this, Teresa? Do you know?
I think, yeah, going forward, especially after 2020, it's going to be, what is your backup plan? I think analysts are going to take a look at that as well. Not that it's the same, but it's sort of the companies that are supporting the ESG movement. Analysts look at that. What are your plans in the next 5 years or 2 years to really hone down on that and be experts and have a good support system? It's also going to be, given COVID-19, what are your plans now for your supply? And suddenly, if the world shuts down, how are you going to provide your services?
Great. So given that, though, this is a conversation around the impacts of elections on the stock market, how much of what we're seeing right now is typical from previous elections, and how much is variant given the current other factors that are at play?
So I'll jump in first to tell you that if you look on the surface of this, by what the national polling is suggesting, it would look historically as if the race has been over from the beginning. That Biden has had a very large lead in the polls since he so why the volatility? What's up? Well, there's the Trump factor, right? I mean, 2016, this is why I'm glad I'm not in the polling business, right? 2016, most of the polls were predicting that it would be a close race, but that it was going to be a Clinton presidency, a Hillary Clinton presidency, and there was a surprise. And that's weighing, I think, heavily on people's minds. It's no matter how big the lead looks to be for Joe Biden, I think that the marketplace doesn't rule out the possibility that Donald Trump could pull a rabbit out of his hat and surprise people. And I think that's why this election is behaving much more like a contested election than the polling on itself would suggest. Does that make sense?
Yeah, and I agree.
How do you see it, Teresa?
I agree with all you said, particularly because of that. People are expecting it to be contested, and it's sort of like we're just hanging on, waiting for Tuesday, and on the days after, just being like so sure that we're not going to have the final answer that day, and that's most of that, the red that we're seeing the last couple of days.
In past elections, Stephanie, it was it was pretty obvious by reading what the candidates had to say in their position papers, the kinds of policies that they would adopt once they were elected. You know, whether they were for a strong defense or whether they were for some kind of healthcare reform. And but this election has been quite a bit less around those kinds of topics, at least from my point of view, and it's been much more around how well or how poorly, depending on your point of view, the President Trump has handled uh, the the whole pandemic issue. And there have really been very few discussions about that would clearly lay out what the differences are between the candidates in key areas. Taxes maybe aside, I agree with Teresa that I think there's going to be a clear difference in tax policies. And this is not a critique in any way. I'm just telling you that I couldn't tell you which industries I would think would be favored in a Trump reelection, because that hasn't been the tenor of his discussions. If you go back to 2016 and you think about it, one of the things he campaigned hard about was not only the wall, but he was also talking a lot about infrastructure. If you remember, we were going to repair all of our bridges, we were going to repair all of our roads. It was going to be this massive investment in infrastructure. Well, I hasten to say that if you bet on that and you got it right, that you picked him as the winner and you went heavy into those industries, I don't think you paid off the way you thought you would. And as we go into this cycle with just a week to go, I don't know that I could tell you what I would be betting on at the industry level. It's been a little unusual in that respect. It's highly contested, but I don't know what we're contesting about when it comes to actual industries. That's a big difference for me.
Yeah, I agree. And, if we're looking at the industries right now, they're still down, or there's still the opportunity for a comeback. Industrials is one of them. We've got energy, we've got financials, we've got real estate, of course. And the industrials is one of them. So it's taking a hit.
Yeah, we did get a little bit of a clue, although they've moderated the tone. We did get a clue from the Biden campaign about what his long-term view of energy is. But I would stress with folks, because he's really backpedaled a bit, but that it is a long-term view of energy. He sees a turn to green and renewable sources. That doesn't necessarily mean you go out and sell all your oil stocks tomorrow. I think he's tried to reassure the public that that's not what it means. But there's one of the very few examples, right, Teresa, where we've gotten even a little bit of an indication of what somebody's thinking at the industry level.
Yeah, you're right. And you're right, with energy, it's just something, it's a very long term. I mean, to start seeing the effects on that and the returns and the good stuff that's going to come out of it, really, it's going to take time. But I'm glad that at least, someone is trying to put that on the table and start doing something sooner rather than later. I personally think we need to.
So speaking of industries, we do have an industry specific question in that investing in commercial real estate at this point, with so many corporations rethinking their office needs, is that more cautionary than maybe previously thought? I know we're seeing a lot of industries in general that were maybe once thought of as very stable, and due to COVID, those calculations have changed. Any thoughts?
I'm glad I don't own buildings at the moment, Teresa, only because the uncertainty level is high. I have to confess, I haven't looked at how those have been priced. So it's quite possible that all of that uncertainty has already caused shares in firms, REITs that specialize in commercial property may have already taken it on the chin. I do think, based on conversations I have with our co-op partners and that are big employers all around the country, and just knowing how we're looking at our own footprint at Northeastern, I think everybody is looking at their physical space and asking themselves just how much of it do we need. And that was, I think, what we have learned in this from this pandemic is that there's a remarkable part of America and of industry that can take place actually at home. And I don't know that we have fully figured out but how big the transition to work from home will be. But I think we all realize that it's certainly accelerated, and that a lot of firms are really thinking about going back very slowly. So yeah, if I was owning commercial real estate, I personally would be nervous. But I can't speak to the what the market is doing to them specifically.
Yeah, well, as of this morning, real estate was down 11% year to date. And so, if we take into consideration the possible volatility that will continue the next few weeks, that number may be higher. Yeah, I have friends whose companies were due to renew leases now in July and June, and they didn't because obviously because of COVID, but also thinking, well, this is some expense that we can save, and we don't necessarily need to have everyone come in here. We can just get together at a rented office space every 3 months and see each other and be just as productive from home. So I agree. It'll be interesting to see where that is going to be in 2 years, when hopefully things will be somewhat back to normal, because, obviously we should never obviously give up on the human contact and seeing each other, but it might certainly tilt towards doing a lot less than that.
So we only have a couple minutes left, but I'd love to give you each an opportunity to just quickly give kind of one piece of wisdom, one piece of advice, if you will. Wisdom, observation is fine, about what we're seeing and what people should have as their takeaway from your observations. Teresa, why don't you start?
And it's hard to just pick one thing, really. But I think I'm going to stick to what I said earlier. Save. Just, if you want to remember 2020 on a positive note, I would say do that, particularly even if it's never late to start having a good budget and saving, but certainly if you're on the younger side, students here, start thinking about that and stay on top of it, because nobody else will. You have to make the time to do that for your own finances.
So I would echo the same thing and say it's never too late to start saving, and you're never too young to start saving. And the second thing I would say is that I have to tell you that I've bet on America for a long time. I've been a buy and hold guy. I have a full-time job. It keeps me busy, and I don't try and day trade. And being a long-term investor and bullish on America has paid off really, really well. And I frankly don't see anything that suggests that that's about to change adversely in the near term. I think we are a remarkably stable country. We have our disagreements, but we're stable. This is a great environment. It encourages entrepreneurship. There's been, I think there's still plenty of new things to be dreamed up and thought up of. And so I think being a long-term equity investor that has a big exposure to the United States is a really good thing. And I hope everybody is doing that, and I hope that they have the same experience that I've had over my working career. It's really paid off. And let me just highlight that with this. I started investing as a very young man. And I was a teenager, actually. I was 13 years old. And the Dow Jones Industrial Average the summer that I started investing was 850. That's not a misprint, 850. And it's over 27,000 today, I hope, still. That's a pretty big run. And there's nothing mathematical that will keep it from going higher. There's no ceiling. There's only the economy. And I'm bullish on the American economy, and I'm bullish on equity investments for the long term.
Great. Thank you both so much. Just going 1 minute over, as I mentioned at the top of the program, we are very, very fortunate to have Teresa here with us. She is the leader of our Atlanta community, alumni community. And I've asked her to just take a quick minute to talk about being connected to Northeastern through the alumni networks that we have. So if you could bear with us for just another moment, I'm going to turn the floor over to Teresa, and then we will release you to the rest of your Wednesdays.
Yeah, thanks, Stephanie. Yeah, it's been a lot of fun. We started the chapter early last year, and it's been very rewarding because we've had a lot of alumni in Atlanta that had just recently moved or had been actually living there for 3-4 years, and they were yearning to just meet other Northeastern alumni, but they just didn't know how to, and they were just hoping for someone to just approach them and just take the first step. So I was glad to be able to help the alumni desk, and I can tell you that wherever you are, certainly take the time to join your chapter there. You can build really good personal relationships and business as well, of course. But that's sort of like little magic that happens when you meet with people that went to your same school, of course, and you can talk about the library and the center and Dodge and you just you connect in a lot of levels, and yeah, it's been a fun opportunity, and certainly I recommend that you do that as well wherever you live.
Great, thank you. And thank you all for joining us. Hope to see you at another event soon. Bye.